Hi friends, welcome to EAKV and this is Vishnu. So guys, in this illustration we have a company named ABC and on which the company is working with a machine called Machine Z. Okay, but the company is planning to replace the machinery Z with X or Y. So some of the details of machinery X, Y, Z are given in the table. So let's check out those details. For Z, it is given there is a book value of 1 lakh rupees, but resale price of Z is 1,10,000. Okay, purchase price of X and Y are 1,80,000 and 2 lakh respectively. Annual fixed cost of the machines are 92,000, 1,08,000, 1,32,000. The variable running cost of the machines are 3, 1.5 and 2.5 per unit. Production per hour. So the production per hour is 8 units per hour for machine Z, 8 units per hour for machine X and 12 units per hour for machine Y. Okay, so this is the main criteria. So for an hour the production of X, Y and Z are 8, 12 and 8. Okay, so and then they have given the salvage value as 10,000, 15,000 and 18,000, right? Okay, after that they have given some of the basic details of the product manufactured. Selling price of the product is 20 per unit, cost of material is 10 per unit and annual operating hour. So annual operating hour is the limiting factor in this problem, which is 2000. Okay, working life of machinery as always 5 years for 3 machines, for every machine. Okay, depreciation is shall be made in straight line method. Advertisement expenses of rupees 8,000 shall be paid for an extra output of product. Okay, so here if the production has been increased from the regular routine, then an additional expenditure of 8,000 rupees shall be spent by the company to sell those products. Tax rate is 14%, cost of capital is 10%. Okay, then they have given the PV factor of 5 years. Okay, then they have asked to make a feasibility study whether which product shall be selected. So I am going directly towards the solution. So for solution I have made a table which contains 4 columns: product, particulars, Z, X and Y. Okay, first of all we need to find out what is the production per year, or the how many products should be produced by each machinery in an year. Okay, so for that we need to take production per hour and available hours. Available hours is always 2000, which is given in the question, and production per hour is 8 and 8 and 12, which also given in the question. So when we multiply these things, we will get the production per hour. So here we will get 16, 16 and 24. So for machine Z is currently working, right? The company is working under machine Z. So we have the normal production as 60,000. Okay, and X also have the same production, and Y the production unit has been changed to 24,000. So any production more than 60,000 should incur an additional advertisement expense of 8,000. So here we have only one machine, which is Y, for which we need to spend an additional 8,000. Okay, so we'll go for the contribution part, right? Okay, so sales price is 20 per product, material cost is 10 each, variable cost as differ 3, 1.5 and 2.5. Total variable cost, when we add material cost and variable cost, we will get 13, 11.5 and 12.5. Therefore when we subtract variable cost from sales price, we will get the contribution per unit as 7, 8.5 and 7.5. And then when we multiply this contribution with the production unit which we have worked out in the first table or the table above, we will get 16,000, 16,000 and 24,000. Okay, when we multiply that, we will get the contribution amount, total contribution amount. Okay, after that, in the illustration they have given the fixed cost, and when we deduct the fixed cost from contribution, we will get profit. So I have already explained about the advertisement cost. So that way advertisement cost shall also to be deducted from the contribution. The advertisement cost is only for product or machine Y. Okay, so after that we need to compute the cash flow. Okay, so we have arrived at profit. Then we need to compute PAT, profit after tax. Okay, for computing the profit after tax, we need to deduct income tax of 14% from the profit. Okay, after computing the PAT, we need to add depreciation. Okay, depreciation we have here as 20,000, 33,000 and 36,400. Okay, so when depreciation is a non-cash expense. Depreciation is just an expense, but we won't spend any amount outside. Okay, it is non-cash expenses, right? It will be shown in the profit and loss account, but that expenses will not deduct any cash amount from the company, right? Yes. Okay, so we need to add it back. So that is the cash flow. So the cash flow will be 32,000 for machine Z, 49,800 for X, and 16,400 for machine Y. So now I will explain how we have computed depreciation. Okay, here I have I have drawn a table on which we have 4 columns: depreciation statement, Z, X and Y. Here for Z, we need to take the resale price. Okay, not the book value. Okay, please keep this adjustment in your mind. Okay, because in this problem we need to compute the feasibility study, not in terms of accounting, or no rules of accounting applies here. So we need to take the resale price, okay, for computing the depreciation. So resale price is 1,10,000 for machine Z. Okay, for other machines we have no resale price given. We have the purchase price of 1,80,000 and 2 lakh respectively. Okay, from those amount we need to deduct the salvage value. So we will get 1 lakh, 1,65,000 and 1,82,000. Okay, when we divide all the amount with 5, we will get the depreciation per year as 20,000, 33,000 and 36,400 respectively. After that we need to compute the net present value. Okay, so for computing the net present value, I have made a table. Okay, I have made a particulars on year 1 to 5 years we have. Okay, after that I have made the PV factor for all the 5 years. Okay, after that we have 3 tables as X, Y and Z. Okay, and I have written here as cash flow for 4 years as 32,000 we have computed, or we have found out from the above table. For machine Z and machine Y, it is 49,800 for 4 years. Okay, and for Y it is 60,400. Okay, let's keep this table apart, and I will show you how to compute the cash inflow for the 5th year. statement showing computation of cash for fifth year. So here we have X, Y and Z. On here I have shown here as cash flow, regular cash flow of the year as 32,000, 49,800 and 60,000 as like all the 4 years, right? Yes. After that we need to add all the salvage value of each product. Okay. So when we add the salvage value, we will get 42,000, 64,800 and 78,400 for each machine, and we need to take this total amount as the cash flow. We need to take this as the total amount of cash flow. Okay, so on the fifth year we have here 42,000 from here. Okay, and here we have 68,400. Here we have 64,800 and here we have 64,400. Sorry, 64,800 and here we have 78,400, which is taken from here 78,400. Okay, after taking those amounts for the fifth year, we need to multiply it with the PV factor. Okay, and we need to take the summation of each machine. So the summation will be 1,27,514 and 1,98,095 and 2,40,140 for machine Y. Okay, after totaling that, we need to deduct the purchase price of each machine. So here for company product machine Z, we have taken the resale price, right? 1,10,000 is the resale price and 1,80,000 is the purchase price of product X and 2,40,000 2 lakh is the purchase price of product X, machine X. Okay, after deducting the purchase price, we will get 17,514 for machine Z and 18,095 for machine X and 40,140 for machine Y. So from here we need to select the machine which has higher rate of NPV, which is machine Y. Okay, so machine Y, as per NPV, we can suggest that machine Y is the best from the three alternative. Okay, but however there are difference in investment amount. So in the above example, the investment amount of each machines are not the same, right? For machine 1 we have taken as 1,10,000, machine X we have taken as 1,80,000 and 2 lakh for machine Y. So in that scenario we need to take the profitability index formula and we need to compute this with profitability index. So the formula for the profitability index are PV of cash inflow divided by PV of cash outflow, present value of cash inflow divided by present value of cash outflow. So here PV of cash inflow is 17,514 and 18,095 and 14,140. These amount are taken from the above table, which is the NPV of three machines. Okay, divided by the investment value, which is 1,10,000 and 1,80,000 and 2 lakh respectively from the question. Okay, after dividing the PV of cash inflow by outflow, we will get 10, 16 for machine Z and 10 for machine X and 20 for machine Y. So from this profitability index formula or profitability index ratio, we can select the best machine as machine Y. So guys, thanks for watching this video. If you find this video helpful, please subscribe to my channel.